Hello traders. So I've been sharing my trading journey for the last few years on this YouTube channel and on my website. But I've always also been investing and buying Bitcoin and gold as a hedge against all the money printing that's going on. Lately I've moved all my investing and trading over to eToro, so I can share all of this with you. And I also want to start investing more in stocks over there. So I have been moving over some of my stock picks, but I've also realized that picking stocks is a very difficult thing to do and it's very time consuming. So I've been looking at ETFs to invest in. ETFs are basically baskets of stocks. Usually they follow an index or a sector or a geography, so you have indexes for specific countries or for emerging markets or for the S&P 500 or maybe for tech stocks. So this is a very easy and convenient way for investing, but there's a big problem with the stock market, and that there are these huge upswings. These are not a problem, these are actually quite good, but also the downswings that can be very devastating. So let's have a look, for instance, at this chart here. You can see the total stock index ETF from Vanguard. This follows all the major US stocks and I believe also stocks from around the world. And you can see that there are these huge drops. So let's say you've bought in right here, then you have to go through all this drop. So let's get some markings that I've prepared. So these are all the drops that you would have encountered. So here we have a 27% drop, a 52% drop in 2008, 12%, 9%, 13%, and here 26% drop when the COVID crisis hit. So how do you get through this? Of course you can just keep on buying, that's one way of doing it, but I've figured let's see if I can find a simple way to avoid all these drops while still having the upside. So what I did is I plotted a 12-month moving average on these 12-month candles, on these monthly candles. And then as you can see, you would have been out of this drop, and then here you would get back in. You would have followed the market up, you would have been out here, and you would have avoided this drop. You would have been in here, you would follow it, the market up, you would be out here, and then you would follow it up. Well, you can see this looks like, if you're just eyeballing it, as a good way of following the market. So being out before the drops, if you can identify them by using this simple moving average. And it looks all good, but I'm a data engineer by trade and software developer. So I figured let's have a look and see if we can quantify this and do an analysis on it, just using the data, and not just do it for this ETF but for a whole set of ETFs. So that's what I've done, and I will share that with you right now. So here's the code that I've written so far. It's a Python code, and let's just run through it. And even if you have no experience coding, I believe this will give you some insight in what is a good way of investing your money in ETFs. So this is what we call a Jupyter notebook, so you can run little chunks of code and you write some comments, so you can annotate your analysis. So that's very useful. I will share this code with you I'll put a link in the description so you can get it. You can run it yourself and check it out. First of all, we're gonna do some imports that are necessary for running our code, and then we're going to get data from a website called stock.com. So let me just show you that website. I don't know, it's stock or stuk, doesn't really matter. It's a website, it's all in I believe this is Polish, so don't be freaked out if you see this website. It's in Polish, but the data is very good. So let's look up our data. So we want to get the Vanguard Total Stock Market ETF. So if we click on that, and then here is the page for that asset, and then here's a historical date tab or link that you can click, and then here you can see all the data that you can get. So you can get daily data, weekly data, and monthly data. We will be using the monthly data for this small experiment, and we will get it in an automated way. So I've written a function here that will get the data. It will also check if we already have the data saved here in our data folder. If we have it already, then there's no need to get fresh data every time from the website. So it just used the data that it already has. Then here's an implementation of that moving average strategy that I just explained to you. So it's a long only strategy. We buy and hold once the price is above the moving average, and we close the position once the price closes below the moving average. So we can do this strategy on the daily, weekly or monthly. I will only test it for now in this presentation on the monthly, but feel free to play around and see if you can test this strategy on the weekly or on the daily, and maybe use other moving averages. So this will return a data frame, so all the data with all the strategy implemented on it, with the profit and loss, and yeah, that's basically it. Then here there's a small function that will actually run the strategy, so it will call the get data function, it will call the moving average strategy function, and it will make a nice plot of the results so we can have a look at it. And then lastly, I also wanted to see some metrics. So the main metric that I'm interested in for strategy is how it performs in a risk to reward perspective on a certain investment horizon. So I want to see how much drawdown I need to go through for how much profits that I can make in a certain period. So let's say in a 5-year period there's a maximum drawdown of 5% or 10%, let's say 10%, and there's a profit in this 5-year period of 20%, then the metric that will be calculated is 2. So you have 2 times the profit compared to the maximum drawdown. So this is basically calculating how much pain I have to suffer before and compared to how much gain I will make. And then also the time horizon is very important. If you have a very short time horizon, the results may be different than for a longer time period. So we'll have a look at that. So let's have a look at an example. So let's say here we have the Vanguard Total Stock Index ETF. We have it on the monthly time frame. We're gonna do a moving average of 12. So we're gonna see if the price is above its yearly average based on a monthly chart. And we want to do the I want to do the calculation of the performance in a 5-year period. So this will run it, and then as you will see here, this is the result. So here we have the stock price, or the ETF's price, going up in percentages. This is, and then as you can see, when this drop is here, then we are out of the market, so we're flat. And then here we are in again, and then here we are out, in, out, and then we take this right up. But all in all, you can see that the total return is less than if we would just do a buy and hold strategy. So this risk to reward metric that I just spoke about, the rolling profit and loss against rolling max drawdown in a 5-year period, looks like this. So you can see the swings are getting bigger, meaning there's more volatility, more changes in the risk to reward. And yeah, we're not going under 0, so it means we do have a positive expectancy, we can say, and the max is 1. So the maximum performance here is that we will probably have 20% profit with a 20% drawdown. And for instance, here at the 0.5, here we would have a 10% profit in this period with a 20% drawdown. So it means we will only make half our money of the max drawdown. Okay, so we can I made this part here so we can run all this on the different ETFs that I'm looking at. So we have the SPY, that's the S&P 500, the QQQ is the tech stocks, Schwab dividend ETF, that's a dividend yielding ETF, etc. So we go through them. We only gonna look at the monthly, and we also gonna do a 1 period and a 12 period moving average. The 1 period moving average means we're just buying and holding, so I can get the results, the performance results also for if we are just buying and holding. So it's gonna run through all the strategies, it's gonna plot it out, and also give us the performance. So let's have a look. We're starting here with the SPY. So that's the S&P 500 tracking ETF. So this is just the buy and hold, and then here we can see the performance. You can see that the performance is becoming better since 2012, and it's going up in a pretty stable way. So could we have done better with this simple strategy? Well, the result would have been less. We would have made less profits, but would we have a better risk to reward? Well, it doesn't look like that. It looks like almost the same. Even it's becoming a little bit more volatile. So the lowest result is 0.2 here and also 0.2 here, so it doesn't make a lot of difference. Then let's go to we already looked at the total stock index, so let's skip that. You can see here the performance is also almost the same. Then let's go to the tech stocks. Maybe we can do better there. So here also there's a trend that the performance is becoming better over time, at least since 2006. And if we employed our strategy, then let's see, we wouldn't have done really much better. So it's almost the same, the risk to reward, at least on a 7-year period. Then we have a dividend stock. Let's see how that is doing. With this dividend stock, we can see that it doesn't get as low with the risk to reward as the other ones that we've seen. Here we sometimes go even to almost to 0, and here we barely touch the 0.5 here, and but also the upside is less. So dividend stocks are definitely more conservative, you can say. So I think that is a good long-term play, because this also doesn't even account for the dividends that are being paid out. So your stock value is quite more stable as it looks, and you have more income as well if you collect the dividends, So could we even do better than this? if we employ the strategy, no, I don't think so. It's almost the same. So immediately I can see now that the strategy that I thought would work on stocks is not actually quite not making much of a difference. So again, the old saying of time in the market is more important than timing the market, I guess that's right. So just buying and holding here looks yeah, it looks better because it gives us more results. As you can see here, we have a higher return in total, and the risk to reward is more or less the same, at least on a long term period of 7 years. So this can change if we take a shorter period, of course, but I'm in this for the long haul, so a 7-year period sounds good to me. So here we have another one. Let's see, let's quickly go through it. Yeah, it doesn't make any difference. So let's quickly scroll down. Here we have oil. So this is an oil ETF, the US oil ETF. So this actually goes quite negative here when it comes to risk to reward, and not really high at all. So here we could be doing better, I think. Yes, we at least we get a little bit higher reward here in the end, but the risk is still the same, the max risk. So not quite a big difference. An ETF, SOXX, I believe that's for semiconductors, so pretty much tech industry. Going up in a straight line, we can see that the risk to reward is getting better and better over time on a long term period, like the 7-year. If we employ the strategy, we have a lower return in total, and let me see here, yeah, the risk to reward has the same kind of pattern, so it's not really an improvement in my opinion. So also for this ETF, it's better to just buy and hold than to employ this simple strategy. Let me see what we have here. Let me just quickly scroll down. Let's see if we have something interesting. Another dividend stock. So this has the same kind of behavior as the other dividend ETF that we've seen. This is a high yielding dividend ETF. So it only holds stocks that have a very high dividend. And the risk profile is more or less the same. So again, here it's best to buy and hold. Looking at all this, I think the dividend ETFs are very interesting because they have a very stable risk to reward profile. They don't go lower than 0.5. They also don't go higher than 1, but you do get a dividend, and that's not accounted for in these analysis. So that's just a cherry on top. So I think I'm gonna have a closer look at these dividend ETFs. Then here, the bonds market, we had this huge drop here since the interest rates were going higher again. So yes, as you can see, the risk to reward is getting very low. Could we have done better with our strategy? Yes, we would have been out here, I think. So we would have avoided this huge drop. Yes, here we did a little bit better. But yeah, still we have in the beginning here we would have been doing worse than here. So I don't know, it's not convincing to me. So these are European stocks. Let me see. Yeah, here as well we can see that it's moving up, the risk to reward. That seems to be a thing with the stocks. Could we have done better with our strategy? Nah, not much. We did have this huge drop here that we didn't even have here in this buy and hold strategy implementation, so I think we would have done worse. Nah. I'll leave you to analyze the rest of the stocks or ETFs for yourself. One more interesting thing I want to show you is what if we have a shorter time horizon for analyzing our risk to reward. Let's see what we will see then, because that was quite interesting what I've seen already. So I'm going to change the time horizon here to 1 year, and I'm going to rerun the strategies. So this is just a buy and hold strategy, and as you can see that the risk to reward, so the profit and loss potential against the max drawdown that we've seen, was quite stable for a long time up until 2020, and then we've seen these huge swings, and now we are at the center again. So clearly this period here since 2020, as you all know, have been very, very volatile, and yeah, it's totally going out of whack. Even if we would have employed the strategy, it would have been the same kind of picture. So let's quickly run through all the other stocks, the other ETFs here. You can see it as well on the VTI, and let's see on the tech stocks, same here. Let's find another interesting one here on the dividend stocks. You can see that the downside is a little bit less than the upside, so there's more upside than downside, so that's also quite interesting. There is some downside if you look on the shorter time horizon, but it's less than, for instance, here with these tech stocks, where you have this huge swing down on the performance, and here there is a swing down, but it's less. So that also makes me more wanna look into these kind of dividend yielding ETFs. So let's quickly go through it and see if I see something interesting here. This is the performance on a 1 year basis for the oil, for the US oil ETF. Yeah, it looks to me as not a market that is investable for a long time. Maybe you can trade it, but I don't think it's a good idea to buy the USO and just buy and hold, or not even implement a simple strategy, because the risk to reward is just way too volatile. Here we have semiconductors. Yeah, same as the tech industry ETFs, very volatile at the end here. It used to be quite stable, but yeah. Let's look at the bonds quickly, how these were doing. So here we have another dividend yielding ETF, same as the other one, so more upside than downside, so that looks pretty good to me. Then yeah, here we have the bonds. You can see they have slowly become more and more volatile. So where the stocks were almost just bouncing around the zero line up until 2020, here you can see that since this analysis started, it's the swings, the risk to reward swings have become larger and larger. Okay, so I'll leave it at this. You can do your own analysis if you get this notebook, and you can play around with the moving averages, or you can see if you get some better performance if you use daily or weekly charts to do your analysis. Let me know if you like this kind of video by giving it a thumbs up, and find the link in the description below to download this notebook. play around with it, and if you have any questions, just leave a comment down in the comment section below. See ya.